When the facts change, you need to be willing to change your mind, like the late, great John Maynard Keynes taught us. But how do you know if the facts have really changed? That's the question I keep pondering every time I think about GrubHub, the online food delivery system also known as Seamless in New York. Back in February, I told you to run, don't walk away from GrubHub, as well as all of its publicly traded competitors. Sell. The stock had already been obliterated, falling from 149 last September to 83 at the time. I predicted more downside. Why? Because the delivery space has gotten way too crowded. Among Uber Eats, DoorDash, Postmates, Square's Caviar Service, Danny Meyer's long-range service Goldbelly, Deliveroo, and Cloud Kitchens, that's, by the way, the latest venture from Travis Kalanick, the founder of Uber, there were just too many players competing for the small business. While competition is great for you as a consumer, it's the last thing you want to deal with if you're running a business. And GrubHub's got a ton of competition. The company's been spending money like crazy to defend its market share, and their efforts, well, let's just say they haven't been all that successful. Sometimes an industry will be booming like this one, but there's no real good way to invest in it. That's an important takeaway, people. Now, it turns out our sell call was good, as the stock's now down about 9% since I warned you away from it. However, in the past month and a half, GrubHub has rebounded dramatically from its lows, rising from 60 to 75. And it made me wonder if maybe I'm missing something here. Maybe something's changed. The reason? On June 11th, it was reported that Amazon would be shutting down its own online delivery service, Amazon Restaurants. Immediately, GrubHub stock caught fire. Multiple analysts came out and told us that this was the major positive event that they're looking for. Buy. After all, if you can outlast Amazon, you got to be in great shape, right? I mean, stands to reason. Not so fast. I think the buyers are getting ahead of themselves here. Amazon was never a major player in the food delivery space to begin with. One less competitor is a positive development for GrubHub, of course, but they've still got plenty of other rivals. And frankly, you can read Amazon's decision not so much as they gave up, but how about this? As an indictment of the whole industry. You got to remember, GrubHub's margins have been under serious pressure for some time. The company's spending a fortune to fend off private companies like DoorDash and Postmates and everybody else who's piled into the business. That's not a very good sign, people. Now, in April, we stopped by GrubHub's headquarters to give CEO Matt Maloney a chance to tell his side of the story. Guy's a candid fellow, is always willing to talk. You know what? I asked him if all the ad spending was worth it. Here's what he said.
So you think about it this way. You know your LTV, your lifetime value of your customer. Once they start ordering, we know that they're lifers. They're on forever. So we can make that revenue model, and then we know how much it costs to put the ad on there. So yes, over time, as people see it more and more, it becomes less and less effective, but we're nowhere near our LTV.
Okay, I always love it when a candid executive is willing to answer tough questions after I've criticized their company on air. Maloney thinks he's got a major opportunity to take share here, and it's worth it to spend the money because once he wins new customers, they'll stick with GrubHub forever. That's that long-term value or LTV. Now, I actually am not so sure about that. In my experience, people tend to toggle between delivery services in order to get what they want. If it's only on GrubHub, well, you'll use GrubHub. But if you want McDonald's, you have to use Uber Eats. If you want Chipotle, you have to use DoorDash. I just don't think there's that much differentiation or loyalty. Sure enough, when GrubHub last reported in late April, the company gave tepid sales and EBITDA guidance for the next quarter, and the stock got hit. And it kept getting hit until we learned about that Amazon restaurant change. In response, the stock surged more than 8% in a single day. And frankly, it hasn't really looked back since. But I think this development is being blown way out of proportion. Amazon Restaurants was tiny. It was only in a little more than 20 cities. When you actually read the analysis here, it's not exactly encouraging. As the Wall Street Journal put it in a cogent piece, quote, the rough and tumble food delivery business is swarming with competitors and is largely unprofitable, end quote. In other words, this industry was too competitive for Amazon, of all companies. How can that be possible for GrubHub? Besides, Amazon's still involved here. They're just doing it indirectly by investing in an outfit called Deliveroo. That's a British delivery system that's expanding to the rest of the world. Meanwhile, the competition, it just keeps getting more fierce. More and more of these delivery platforms are forming exclusive partnerships with major quick-serve chains. Dunkin' Donuts now delivers via GrubHub and Seamless, that's them. But Chili's uses DoorDash. Oh, and this is a fickle business. McDonald's, which reports next Friday, will be very interesting. I think it's going to be good. McDonald's had to deal with Uber Eats, but now they're diversifying, partnering up with DoorDash, too. If you're a major restaurant chain, you can play these delivery platforms against each other to get much better terms. I know this. Now, we use Caviar, which is owned by Square, at our bar and our tavern in Brooklyn. We have no power over pricing whatsoever. We have to price take. But I'll give this industry its due. You really almost have to have takeout and delivery these days if you're going to succeed, even if the delivery folks take a hefty double-digit % of the check. What else? Well, GrubHub has been spending aggressively to protect its market share here. It turns out that DoorDash overtook them to become the largest food delivery service in America in May, 300,000. Customers. While DoorDash is privately held, it just got $600 million in fundraising that valued the company at $12.6 billion. GrubHub's market cap isn't even $7 billion. Everybody's been focused on Amazon's exit, but maybe they should have been watching the ascent of DoorDash. I think DoorDash is a rapacious, tough competitor. So rapacious that there may be no winners in this battle. Plus, like with many of these internet plays, they can toy with small businesses. State-level regulators, they're trying to get involved. They may start intervening on behalf of, say, GrubHub's customers. The New York State Liquor Authority recently rolled out new rules that would potentially force GrubHub to reduce its fees from 15 to 30% down to 10%. That'd be amazing. The State Liquor Authority probably doesn't have the power to actually make it happen, though. Perhaps worst of all, earlier this week, we broke some news here that I don't think people caught. We spoke to Rich Allison. He's the CEO of Domino's Pizza after his company missed the numbers. Allison blamed part of the weakness on money-losing companies that are effectively being subsidized by their investors to take unprofitable market share. Listen to this.
I don't know how that's going to shake out once consumers actually have to pay the full cost of that delivery, because those fees are quite substantial relative to the cost of the underlying food. I think we also have not yet seen what's going to happen with the supply of restaurants on these platforms as well.
Ouch. Now, maybe GrubHub will surprise us when it reports its next quarter in a couple of weeks. But the bottom line is that Amazon is getting out of the food delivery space. That doesn't change anything. GrubHub is still facing relentless competition. I think it's way too risky to own here, even as they pioneered the online delivery business and were initially able to battle honorably and grow unfettered. But that was before there were a bunch of well-funded competitors fighting over the exact same customers. Greg in New York. Greg!
Booyah, Professor Cramer.
Thank you, Greg.
Confessions of a Street Addict now. It's my third book. Love doing the homework.
Thank you so much. Holds up, they say. What's going on?
Well, something that didn't catch many headlines was that 45,000 barrels of Jim Beam caught fire a few weeks ago. So my question is twofold. One, when can we get together at Longshoreman or Bar San Miguel for some Jack Daniels or Woodford Preserve? And two, Jack Daniels is the main brand for Brown-Forman. It's been trading sideways. What do you think of BFB?
I actually like the brand. It's caught up in some tariff wars. I like the brand. But just so you know, I mean, we at the Longshoreman, which is the place that my wife co-owns, well, I co-own it, but that's where we serve the Browns. We just do Mexican stuff at Bar San Miguel. I think Brown-Forman is a great brand. I think Diageo is doing better. Okay, let's go to Dennis in Rhode Island, please. Dennis.
Booyah, Jim.
Booyah.
So my question is about Alibaba. I'm a current holder of Alibaba, and with the upcoming stock split in 2020, would you consider buying more now or wait until after the split?
Stock split creates no value, sir. I think that you have to bet that the trade wars are going to end to buy Baba, and that's one of the reasons why I've been so low-key recommending any Chinese stock. It's just too difficult. All right, Amazon getting out of the food delivery space doesn't change much for GrubHub. It's still a relentlessly competitive space. On Mad Money tonight, we're celebrating the 50th anniversary of Neil Armstrong's moonwalk. Don't miss Morgan Brennan's report, our own, from Kennedy Space Center about how far we've come and where the next frontier of space travel will take us. Then the dog days of summer are upon us. But before you kick back at the pool, you need to make sure your portfolio is in shape for the summer. That's right, it's MI Diversified time, and all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.